e.l.f. Beauty is one of the businesses most significantly impacted from the recent announcements from President Donald Trump on tariffs on trading partners. The last estimate was that e.l.f. Beauty manufactures 80% of its goods in China, and given that over 100% tariffs are likely to go into effect on midnight, April 8th, Tuesday, 2025, e.l.f. Beauty stands to take a significant increase in its cost of goods sold. Already in February of 2025, the company revised its full year outlook for the year downward. It was beginning to feel the pain even before these increased tariffs came into effect. All that being said, the stock price is down so much in 2025. Does that mean that it's already accounted for in the valuation and this is a buying opportunity on the dip? I know a lot of you have that question, and I'll answer it here in this video. Based on my review of the company's prospects, I'll also share with you my proprietary discounted cash flow valuation for e.l.f. Beauty to show you if I think the stock is fairly valued, undervalued, or overvalued at current valuations. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I mentioned e.l.f. Beauty stock down over 59% already in 2025. Now, even before these declines, I evaluated e.l.f. Beauty's business, and I told investors that the stock was not a buy. I didn't like how the company had to spend so much money on marketing and advertising in order to generate its sales growth. I felt it was not quality sales growth. That being said, the company is generating huge increases in revenue. Over the last few years alone, its revenue has jumped to 1.3 billion, up from 400 million in 2022. However, that's not created an increase in cash flow. You can see the cash flow from operations to sales ratio is actually down meaningfully from 2019, where it peaked out at around 25%. It's down over 90% to 2.67%. That just goes to highlight the point that I made earlier. e.l.f. Beauty is generating sales growth, but it's spending so much to generate that growth. And that's not very organic. I like to see businesses that can generate organic demand. Sure, it's okay to generate growth by spending for that growth, but I'm not going to be as excited about a business that has to spend so much money to generate that growth. Now, with the addition of tariffs, the cost of goods sold is going to increase meaningfully. And so the margins are going to contract even more because the company will likely need to raise prices or absorb those costs so that its customers don't see higher prices. And given how promotional e.l.f. Beauty has been in the past, I wouldn't be surprised if the company doesn't pass along all of the higher costs onto customers. I wouldn't be surprised if the company absorbs some of those higher costs so that it continues to generate sales growth or it doesn't experience a big decline in sales. This company is very interested in growing the business more so than increasing profitability. It wants to generate increases in revenue and then think about profitability and cash flow later on down the line once it's gained meaningful market share and has become a habitual part in its customers' routines. Then it can think about becoming a more cost-efficient business. The returns on investor capital were doing better, but again have been on the downtrend and are likely to continue moving lower given the tariffs. At 10.34%, the numbers are okay at this level, but I don't like that trend line downward even before these tariffs were implemented. I updated my discounted cash flow valuation model for e.l.f. Beauty stock, and the fair value of this business, according to my updated predictions, or not predictions, updated calculations, I should say, is $43.02. That compares unfavorably still to the current market price of $51. That's near the company's 52-week low. This stock was trading at a high of nearly $220 over the last 52 weeks. Looking at valuation from a different perspective, the forward price to earnings ratio on this business is just 12.2 now. It was trading at a forward PE over 60 just a little over a year ago, and to start 2025, it was trading at a forward PE closer to 40. I argued in my evaluation of the business to start 2025 that it was too expensive given its prospects, given the organic demand, given the higher advertising. And so that's primarily why I did not have this stock rated as a buy for 2025. Neither did I have it rated as a buy for 2024. Now, one interesting thing to note is that the company's weighted average cost of capital of 12.3% compares favorably to the company's return on investor capital at its peak levels of over 25%. However, at the current level of 10.34%, the weighted average cost of capital is higher than the company's return on investor capital, which is something I don't like to see. Now, I'm okay with companies having a higher weighted average cost of capital compared to the return on investor capital if I'm reasonably confident that it's heading in the right direction, which I'm not with e.l.f. Beauty. You see, it's heading in the wrong direction, and the tariffs are still to come. So I'm not confident that its return on invested capital will return to levels above its weighted average cost of capital anytime in the next 12 months, maybe not even in the next 24 months. So for all of those reasons, if I were to update, and I am updating my recommendation here for e.l.f. Beauty, I had it rated as a hold all year long in 2025, and I'm updating that recommendation today, April 8th, 2025, that I think this stock is not a buy, it's a hold. Hey everyone, I'm excited to announce a brand new private Discord for our channel members at the VIP Discord level. It's a great place to connect with me directly, engage with like-minded investors, and learn more and take your investing to the next level. Spots are limited, so join now before it's too late.